Jeff, very good to see you. Today we are talking through 5 retirement investing mistakes. A financially secure and happy retirement doesn't just happen. It takes a lot of planning and, of course, modifications as you get older. So we're going to walk through some mistakes. Mistake number 1, not having a plan, which is essential to addressing retirees' number 1 fear of running out of money in retirement.
Yeah, that's absolutely right, Erin. It's important to have a good foundation for your retirement plan. When people retired years and years back, they had Social Security and a large pension possibly,
Yep.
but now things are a lot different. For most people, they don't have that large pension to count on. And so it's important to have a really solid plan on your retirement nest egg, how we invest those funds.
hmm Which is much more than just relying on your 401k, which is not a plan.
Yeah, absolutely. That's right.
All right, mistake number 2, forgetting to account for inflation.
That's right. Inflation really is the silent killer of your long-term financial success in retirement. We see that things are costing a lot more now. Inflation has really reared its ugly head recently. But if you compound that over a decade or 2 decades, things are going to cost an awful lot more. And so you can't just leave your money invested under the mattress. You have to invest it to outpace inflation to give you the best chance of success in retirement.
Good point. All right, mistake number 3, not working now to create tax-free income in retirement. And why is now the operative word?
Yeah, that's absolutely right. My dad has always joked that it's important that we're cheerful taxpayers and cheerfully pay as little as possible in taxes.
Good
Obviously,
advice.
in a legal way, of course, but
Right.
it's important to have diversification of your taxability of your funds also. Uh, if we look back in the history of the United States, the marginal tax rates have been a lot higher than they are right now.
hmm
And the US has really accrued an awful lot of debt. And to pay for this debt, it's very likely that tax rates will be increasing in the future. And so if we can diversify our assets, have your traditional IRA and 401k accounts, as well as Roth type of accounts, that gives you more options into retirement that allows us to, again, hopefully pay a lower tax bracket.
Yeah, you bring up a really good point. We are living in historically low tax rates right now, and I think the debt stands at, is it 34 trillion? Probably higher than that since I've looked at it last, right?
It's way up there.
Yeah, climbing. All right, mistake number 4, investing too conservatively, especially if you have a long time horizon.
Yeah, that's absolutely right. We talked about this a little bit with the inflation question, but again, investing too conservatively means that you're giving up some risk right now, the risk of loss, but it's creating an even bigger risk, the risk that your money's not going to be there for you later on down the road. You're going to not be able to outpace inflation, and your funds won't be able to give you a great standard of living later on down the road.
The other side of that coin, though, investing, taking on too much risk as you near retirement.
That's right. There's a risk called the sequence of return risk.
Right.
And this means that you're starting to withdraw your money just as the market has tanked. So like in 2008, the market crashed by almost 50% for those people that were invested very aggressively at that point. Once you're drawing those monies out, it's very difficult for your funds to recover. Once you've taken them out and you've spent them, it's going to be really hard to get that money back to where it was before. And so we have to have a good plan. We talked about initially having a solid foundation for your investments in retirement. And that's what a good plan will actually do. It'll help you to have a solid plan to mitigate risks and give you the best potential long-term success in retirement.
Right. And it's more than just simply buying more bonds or decreasing your bonds, right?
Yeah, absolutely. We want to have, again, a good allocation of that, stocks
Mhm.
and bonds, but also we want to look at alternatives. We want to look at different strategies that give us the best opportunity for long-term success.
Right. Jeff, this was very helpful. If somebody would like to talk to you more about how they're allocated right now or working now to create that tax-free income, how can they get a hold of you?
Yep, they can give us a call directly at our office here. It's 405-681-9633, or take a look at our website, Jeff at or GortonFinancial.com.
Perfect. All right, Jeff, thanks so much.
All right. Thank you, Erin. Have a good day.